Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are responding to the reopening and reversal of reopenings in the economy. And Phil, it's quite impressive to see the way U.S. equities staged and opened this morning, considering the latest news on COVID-19 and state shutdowns and slowdowns.
Yeah, the case numbers have still been pretty strong, hitting over 50,000 last week. And I guess what you've seen in the equity markets is we priced that in the week before because we could see it coming. So the week before the end of June was really the week that was the bear market week. Last week was a super positive week. And I think what's supporting the market is the economic data that's coming through, which is somewhat lagged just because it takes a while to collect, has been mostly above expectations. So not awesome, but way less bad than people thought it would be. Unemployment, with the rate coming down to 11-ish% now, way above expectations of a much worse number. Things like the PMI indexes show that companies are getting people back to work a lot faster than economists had expected. And so net, the economic surprises are coming through positive. And that seems to be more important right now than the fact that the rate of infections in COVID in the southern states in America and a lot of the emerging markets is still increasing. And it looks like, at least in Texas and Florida, and maybe even in Arizona, some of the hospitals are about to reach capacity. So they're having similar problems that New York had in terms of how many coronavirus cases they've got and the stresses on the health system. And then obviously we know that's probably going to translate into slowdowns in their economy because people are going to be more nervous to do things like going to restaurants.
Well, if we take a look at our second chart here, the daily cases, it's higher than it was in the peak in April by a significant amount.
Yeah, but I think one thing we've got to keep in mind is back in April, we didn't have such good testing. We had a lot of people that turned up at testing sites and were basically, or tried to go to a testing site and were told, if you're not sick enough to go to hospital, stay home, come out if you are sick enough to go to hospital. So it probably undercounted a lot of the cases that we saw in New York City and the area around New York back in April. There's some statistics that show maybe the spike that we've got now in July from the southern states is not yet as bad as the spike we had in April. And remember, in New York City, we fired up a emergency hospital in the Javits Convention Center and the hospital boat that came into the harbor as well. So there was a lot more strain on the hospital system in New York back in April compared to so far what we're seeing in the southern states.
All right, if we take a look at our final chart here, I always enjoy looking at this when we look at ETF flows. It also gives you a nice picture into what investors are looking to put their money to work.
Yeah, so this is looking at last week's data. And like we've said before, we basically look for what the investing universe is suddenly focused on. So we look at asset growth or shrinkage. We look at volume trading above average, value trading at high levels, and also the price returns. And we kind of combine all those scores together. And the top 25 from last week really does have a few standout trends. And obviously ETFs are 30% of all the value traded in the market, more if there's a macro shock. So there's a lot of investors, there's a lot of smart money, there's a wisdom of crowds aspect to looking at what they're interested in. And you can see a couple of things. There's still a new economy trade going on. So there's a lot of internet and innovation funds. There's a lot of trading in semiconductors and online retail. So you've got those kind of thematics still being quite active. But you've also got a lot of retrading happening last week. And obviously, if we're not going to go back to work for a year, or if we're not going to go back to work in the same format, and we're not going to need as much office space, a lot of the commercial REITs are probably going to be at least seeing less rent in the short term and maybe needing to restructure the sort of office space that they have. So that's a pretty interesting development that people are focused on REITs right now. There's a little bit of a growth trade in here still, some outflows from growth funds. So we've talked about the fact that when coronavirus hit and interest rates got sent down, a lot of the growth outperformed value. We've seen some weekly shifts into value out of growth and back. And it looks like net last week, we probably saw a flows out of growth. That's net positive for the longer term market because it's possibly showing that people think interest rates aren't going to be as low for as long, which would indicate people think that the recovery is going to be stronger and we are going to be able to come out of these ultra low interest rates a little bit faster than potentially expected. The last thing that's in here is that there's actually some interest in utilities and discretionary ETFs, which of course are the opposite to a recovery trade. They're pretty safe assets, and they've been seeing some inflows as well.
All right, Phil, thanks so much for joining us on Trade Talks as always.
You're welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.